Hello friends, last week in my video, I said that the HNI traders or big money traders were actually trying to cut down on the element of risk in their portfolios. And sure enough, the first three trading sessions of the week saw exactly that. Friday was a different kettle of fish altogether. You suddenly saw risk expansion thanks to good news of Adani receiving funding and investments from an overseas investor, and the inflows in dollar terms also boosted the rupee and gave us a feel-good factor. In my article of Live Mint of the previous week, which I shared on my Telegram channel, I said the month of March is a very special one because mutual funds tend to boost their NAVs by lending support to stocks because this is their annual report of sorts. And sure enough, we saw fund-based buying on Friday because traded volumes were significantly higher. And on your screen right now is the market roundup window, which tells you that it was the banking space that actually led the run-up last week. And the broader base Nifty 50 brought up the rear. The US dollar index was weak, which lent support to emerging markets, including India. And a weak dollar boosted both gold and silver. And it saw a worrying rise in crude oil and natural gas. Now, the Indian 10-year benchmark bond yield continued to rise but settled at 7.43 after spending three consecutive sessions at 7.45. The NSE gained 1.33% in market cap, which is good. MWPL continued to rise, which is routine after an expiry, and the US market provided tailwinds to the Indian markets. Let's now turn to the MWPL, which saw a routine rise. Compared to the previous 4 months in question, the MWPL has risen very, very lethargically. That tells you that risk appetite is marginally lower. Not surprising because the markets were a little nervous. Now for the turnover. Now this is turnover for all three consecutive series, which is March, April and May, and turnover has fallen sharply. Admittedly, the prior week's turnover was higher due to expiry, so some amount of a bump up was expected there. Look at the way stock futures turnover has come down sharply. That tells you that risk appetite is really falling because stock futures tend to be a whole lot more volatile. As a matter of fact, I've recorded a YouTube Shorts video about the implications of what happens when traders move from shorts to, individual stocks to indices. Please take a look at that also. Now, the advanced decline ratio, which after staying below 1 for 3 consecutive weeks, has gone up. Now, that's a bullish sign because one Marshmallow traders or intraday traders suddenly saw signs of revival in buying conviction. This is all thanks to the rise in Thursday and Friday in the market internals. So the late rally has seen some amount of revival in sentiments. Now we need follow-up buying to basically trigger more upsides. Now for the basis. The basis is nothing but the premium or discount prevalent in futures compared to cash. Both the indices are at a premium to spot, but the basis has contracted fairly sharply. At least in the case of Bank Nifty, it's noticeably sharp. Now, I had told you that basis of this magnitude was unlikely to be sustainable because with time, as expiry comes closer, the basis does tend to expand. So we must give that element a room for thought as well. But at higher levels, there was distinctive unwinding due to nervousness, and that resulted in basis coming down a little. Now for our in-house exclusive indicator, the impetus, it is measuring the momentum or the force behind any prevalent move. So last week, we've seen a rally in both the indices, but the impetus has fallen. That tells me that the upthrust lacked force. This is not exactly a very good sign. I would have wanted the rally along with rising impetus, which would have told me that the force was with the buyers. Unfortunately, it wasn't. Now for the LWTD, exclusive indicator that again you will not find anywhere else in the internet domain. Now the blue line tells you that the Nifty future, the Nifty spot, gained 0.74% on a week-on-week basis, but the LWTD continued to fall for the third week in a row and has stayed below zero for the second week in a row. That tells me that fresh buying support at higher levels will be very poor. Buying support at lower levels, which is short covering, may come. Now, there's a big difference between fresh buying and short covering. Please make a note of that. What I'm saying is that fresh buying at higher levels may be lethargic, but buying or short covering at lower levels might cushion the declines. I update this indicator on my social media accounts every day, so do connect with me and update yourself there. Friends, I now come to the bond market, which basically saw bond yields rise by 1 basis point on a week-on-week basis. Before I proceed any further, I have, according to my promise, updated an opportunity for fixed income investors about a relatively safe fixed income avenue, and the details are posted on my free Telegram channel. We don't offer any paid services, so please feel free to subscribe to that Telegram channel. Returning back to the Indian 10-year benchmark bond yield, what we are seeing is the yield slowly but steadily edging higher. Now, if at all we were to see the level of 7.50 or 7.55 being overcome forcefully, it could lead to significantly higher levels in the medium term. So, should you be laddering your investments in the fixed income domain? Yes, continue to ladder. But should you go all out? No. This is something that I have been telling you on our free Telegram channel. Leave a few check leaves spare for the peak rates. I don't think rates have peaked. I've given you enough amount of corroborative evidence as to why I think rates have still to peak out. Please connect with me on my Telegram channel. Now coming to the Bank Nifty, which rose on 3 out of 5 trading sessions and logged gains of 3.36%. What you are seeing on the daily chart is the price giving a significant jump up on Friday and closing above the 25-day exponential moving average, which is a month-long holding on cost of an average bull, but the average remains pointed downwards. The 41,840 level, which is a prerequisite for a jump higher, is still to be overcome. So a confirmatory rally is still to be seen. Turning to the weekly chart, what we are seeing is a bullish engulfing pattern. The bullish candle has really overshadowed the previous bearish candle, and that tells me that a little bit of follow-up buying can see revival in the Bank Nifty. But it's early days yet. In the week before last, this index was at number 4 on a most volatile counters list, and that's exactly where it remained. And last week, I advocated a range between 41,375 on the upside and 38,400 on the downside, which held because the high, in spite of it being higher than my advocated level, was at 41,390, which is a mere 15 points above the level I suggested. In the coming week, I expect a range between 42,750 on the upside and 39,750 on the downside. I would still suggest you continue to trade light. Friends, I now come to the Nifty 50, which managed to gain 0.74% thanks to Friday's rally. It rose on 2 out of 5 trading sessions, as you can see on the daily chart on your screen. Look at how the thick red trend line has lent support to the Nifty. That is the line which connects the peak of the October 2021 highs with the following highs. The price still remains below its month-long moving average, And even though there is a bounce, the average still remains pointed downwards, which means the pressure still remains. It's early days yet. And 18,115 level, which I advocated as a threshold, still needs to be overcome. Coming to the weekly chart, what we are seeing is a very small bullish candle, unlike the Bank Nifty's case where the bullish candle overshadowed the prior bearish candle. So bulls on the Nifty are not half as convinced as they are on the Bank Nifty. The price remains below its 25-week exponential moving average, which is a 6-month long holding on cost. That tells you that the medium-term outlook still remains under pressure. Friends, in the week before last, this index was at number 8 on our most volatile list. It fell one notch to number 9 because the volatility came down due to a narrower trading range. Lower volatility is always welcome for a small retail trader. Last week, I advocated a range between 17,950 on the upside and 16,975 on the downside, which held perfectly well. In the coming week, I expect a range between 18,075 on the upside and 17,125 on the downside. Friends, I now come to the last bit of statistical analysis wherein I measure the retail risk appetite thanks to their turnover that they contribute. What you are seeing is a sky blue line which indicates the turnover contributed by stock options, which is higher last week compared to the prior week. Stock futures turnover indicated by the olive green, army green color is also higher. Index futures line, which is red in color, is more or less flat. And let's see what the index options futures are suggesting. The turnover is actually lower. Index options are the least risky of them all. The fact that traders are taking a very low risk to index futures and they're taking a very small exposure there tells you that they are betting on high volatility individual stock futures. So risk appetite is definitely there. Will follow-up buying come? That remains to be seen. Do remember that the coming week is a short one thanks to a holiday due to Holi. I now come to the most exciting and popular aspect of this video for statistically minded traders, wherein I give you 5 stocks that have gained the most amount of impetus on Friday and 5 stocks that have lost the most amount of impetus on Friday. The impetus gainers, you take small exposure, wait for large price moves. Impetus losers, you take big exposure, wait for small price moves. This is for scalpers. The list is only for Monday. If you want to be updated Tuesday through Friday, please subscribe to my free Telegram channel where this list is updated. So the list of impetus gainers is led by Alchem, followed by Adani Ports, then ABB, AB Capital and Colgate. The impetus losers list is led by Indigo, followed by ONGC, Tech Mahindra, Idea and LIC Housing. Friends, what would I do in the coming week? Well, I would continue to bet on theta decay in select interest rate sensitive stocks, which I have been doing since the last couple of weeks as I've shared my ideas with you. Energy space, both crude oil and natural gas, might just see a little bit of an uptick due to geopolitical reasons. Do remember, President Vladimir Putin has cut off gas supplies to Poland because Poland has supplied tanks to Ukraine. And he's threatening to basically raise prices and curtail supply. So supply side issues remain, because of which oil and natural gas might just go up a little higher. Don't be in a hurry to short. There will be good time. And these are things that I update on my Telegram channel, so do connect with me. I haven't yet bought the USD INR as a tail risk hedge, which I talked about recently in my weekly video. I'm waiting for the right time and opportune time. I'm not buying the USD INR for generating alpha. Do remember, I said tail risk hedge, just in case. So tail risk hedges are normally to be bought at bargain basement levels, and I don't think bargain basement has come so far. Friends, before I wind up this video, a reminder to like my video, subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here in the comment section. Do let me know how my videos are helping you trade better. Also, help me reach out to fellow like-minded smart traders like yourselves by sharing my video with your friends and family. Thank you for your patience. I wish you have a very, very profitable week ahead. Vijay Bhambwani signing off for now. Take care. Bye-bye.